Passive Pockets is presented by Equity Trust. Today we're breaking down how self-directed IRAs and solo 401ks can unlock tax-advantaged real estate investing. Self-directed retirement accounts offer a powerful way to invest in real estate, but most investors don't realize the full range of opportunities or the potential pitfalls. How can investors maximize these accounts while avoiding tax headaches like UBIT? This is a full breakdown of everything you need to know. Hello, passive investors. Welcome to Passive Pockets, the passive real estate investing show, brought to you by Equity Trust. I'm your host, Paul Shannon, along with my co-host, Jim Pfeifer. And today, we're joined by John Bowens from Equity Trust to break down everything you need to know about investing in real estate syndications with self-directed retirement accounts. Let's jump in.
John, welcome to the show. The first thing we want to talk about, obviously, is self-directed retirement accounts. So if you can kind of just tell us what that is and give us an overview, that'd be great.
Yeah, absolutely, Jim. So when you hear the term self-directed IRA, what you want to think is that's an industry term. So it's not a specific by law type of account. You're not going to see in publication 590 of the IRS or in section 408 of the Internal Revenue Code self-directed IRA. So for anyone out there that goes and tries to find that, they're not going to see that. Self-directed, again, is an industry term that just indicates that you have the ability to take control and invest in what you want to invest in. So I know a lot of folks that join this podcast, they're interested in investing in real estate. And that's something that Equity Trust and that we've done for a lot of years, which is have individuals utilize their IRAs, their self-directed IRAs, to invest in real estate and other types of real estate-based assets, including real estate partnerships, syndications, private debt funds, and much more. So when you hear that term self-directed, again, just remember it's an industry term. Now, other financial services firms that can open an IRA or a 401k, they can allow you to self-direct the IRA or 401k, but in many cases, they can only allow you to self-direct into traditional public market investments or securities like stocks, bonds, mutual funds, ETFs. There might be some variations of real estate or alternatives like publicly traded real estate investment trust, or they're sometimes are referred to as publicly traded alt type funds. But in terms of being able to hold, for example, a rental property or being able to invest in a real estate partnership or syndication that you oftentimes see through different online platforms or crowdfunding type network systems, those types of opportunities is where you need a self-directed IRA with the right type of financial institution that has the pipes and plumbing and the infrastructure and the personnel and the education to be able to accommodate those types of more unique asset classes.
Typically, when you see your IRA, it's either in a 401k with your company or it's on a brokerage platform somewhere. So we're talking about taking it off the brokerage platform and kind of having a trust company, and maybe you can talk about that, but just holding it yourself and choosing which investments it goes in, and it can go in pretty much anything. Is that correct?
That's correct. So in terms of being able to self-direct into real estate syndications, private debt funds, it's not a matter of legality, but rather a matter of choice. So in fact, if you go to the IRS website, irs.gov, and you search IRA FAQs and you scroll all the way down to the bottom of the page, it actually states, I'm paraphrasing here, but it states that real estate is a permissible investment within an IRA or 401k, even HSA health savings accounts, solo 401k, Roth IRA, SEP IRA, simple IRA. It's permissible, but due to the administrative burden, most financial institutions don't allow you to do that. So again, it's not a matter of legality, but rather a matter of choice. So you have to find the right trust company, also referred to as custodian, again, that has all of the technology, the personnel, the support that will accommodate these types of, again, alternative investments. And when you hear the term alternative investments, we're referring to alternative to the traditional stock market. So we would include in that category real estate syndications, private debt funds, investments in even cryptocurrency, physical gold and silver, and much more. Certainly at the core of what I do and what we do and what we talk about on podcasts like this, of course, is real estate. And that would be owning, for example, a single family rental property in a self-directed IRA or 401k or even HSA health savings account. The ability to invest as an LP in a real estate partnership or syndication, or an LP in a private debt fund, or being able to use the IRA to make a private money loan secured by real estate. So for example, we have investors, and I've worked with hundreds of thousands of people over the years that loan money secured by real estate to other fix and flip investors. And then all of their interest and principal payments flow back into their self-directed IRA. So I think it's just important for folks to understand the mechanics of traditional financial services, unfortunately, doesn't allow alternative investments. And when I came into this business nearly 20 years ago, I was a financial advisor in training, and I spent thousands of dollars academically because my background is in financial services and real estate. And not until I came to the company nearly 20 years ago and met our company founder, Dick Desich, who's widely known as the pioneer of the industry, did I know that you could hold real estate in an IRA. And I'm sure you guys get that all the time. And there's probably plenty of people that are on this podcast listening and saying, why has no one ever told me that I could own real estate in an IRA? And oh, by the way, there are all of these unique tax advantages. Even in some cases with a Roth IRA, the ability to have tax-free compounding growth and tax-free withdrawals in my retirement. I get that question asked all the time. And I respond, I say, look, I was the same way. And the reality is traditional financial services does not have the financial incentive to tell people about this, right? Traditional financial services is stocks, mutual funds, pre-built portfolios, right? Public market investments. And I'm not disparaging that occupation or that investment strategy. Maybe that investment strategy works for some folks. But for myself and a lot of the people that are within the community that I operate in, they're interested in real estate. They want to own hard assets. They want to own real estate investments, whether it's rental properties, real estate partnership type syndications, self-storage. Once we get into those more salient asset classes, we can certainly talk about that. But that's where I find folks are attracted to the self-directed IRA, is because they want to invest in an asset class that goes beyond the traditional financial market.
Yeah, I think that's great, John. I really love the idea of having more control and also more options, where sometimes it makes sense to invest in public markets, but at other times there could be private opportunities. So just having the access and the ability to do so through a retirement account is really attractive. I want to ask you about choosing the right custodian. What are the benefits and different trade-offs that investors might want to consider as they're looking at different companies? But before we do that, you mentioned something earlier. You talked about self-directed IRAs, and then you mentioned solo 401ks. Can you talk to our listeners about what the differences are between those two and who may or may not be able to qualify for either?
So we have the broad self-directed term, and you can self-direct a traditional IRA. You can self-direct a Roth IRA. If someone has a rollover IRA, maybe they had a 401k from a previous employer and they roll it over into what we call a rollover IRA, they can transfer that into a self-directed IRA. Many Americans are familiar with the traditional IRA, or as we call it, the pre-tax IRA. So what we mean by that is when money went into the account, you got a tax deduction for it. It grows tax deferred. So you can invest in real estate and real estate partnerships like we talk about, and you can have tax deferred compounding growth, which of course can have its advantages. And then when you withdraw the money from the traditional IRA, the amount that you withdraw in your retirement, you pay taxes on. It's based on the amount that you withdraw from the account. And so folks that have 401ks from previous employers, thrift savings plans for those that work for the federal government don't get a 401k, they get a TSP, deferred compensation 457s, 403bs, SEP IRAs, simple IRAs. For the most part, those can be rolled over or transferred into a traditional IRA. Now, the opposite of the traditional IRA is an account type called the Roth IRA. And my hope is that a lot of listeners pay very special close attention to the Roth IRA because of the compounding interest in the absence of taxation advantages, I call them. So the Roth IRA is funded with after-tax dollars. It grows tax-free, and then when you distribute the money, you pay 0% tax as long as you follow all of the rules and guidelines. To give you a quick example, in 2011 and 12, I had a husband and wife couple, Kevin and Cynthia, and they had 401ks with their previous employers. They rolled those 401ks over into traditional IRAs. They didn't have Roth IRAs. In fact, for a long period of time, they were told that they made too much money to contribute to a Roth IRA. But then the law changed in 2010. So prior to 2010, higher income earners couldn't convert from traditional to Roth and couldn't even contribute directly to a Roth IRA. They lifted those laws in 2010, and it allowed all income earners to convert from traditional to Roth. So Kevin and Cynthia converted their funds from traditional to Roth in 2011 to 2012. They actually spread out their tax burden over 2 years. We call that converting in stages. And maybe even in a separate podcast, we can talk about that in more detail, where you convert over multiple years. And so they did that, and then they started buying off-market real estate. And their strategy was to buy, force appreciation through improvements, off-market transactions. They would then sell on owner financing, rent-to-own, and lease option to purchase. And they've grown their Roth IRAs to well over $2 million in property value. They still have 14 cash flowing properties to this day. They generate over $200,000 in net tax-free cash flow every single year. They have their portfolio of properties in their Roth IRAs, and then they also do private money loans secured by real estate to other investors. So they have sort of a very passive private lending portfolio, and then they have their buy and hold rental properties in their Roth IRAs. But over $200,000, and they don't pay a single dime of tax on any of that income. There's no Schedule E. There's no worry about depreciation. There is no depreciation because it's all tax-free growth, so they don't have to worry about it. And they can distribute the money because they're over 59 and a half now, and they pay 0% tax. So the Roth IRA, from a compounding interest in the absence of taxation perspective, can be really, really powerful for individual investors. And there's different strategies with respect to converting from pre-tax to Roth, making annual contributions, backdoor contributions. And then the last two account types that I'll mention, you mentioned it, Paul, the solo 401k, the self-directed solo 401k. Now, I should mention, because there's a lot of misnomers out online and on YouTube and Instagram and some of the other platforms. And that's why I really appreciate you guys at Passive Pockets and Bigger Pockets, where you guys do a great job of educating the masses on, what are the facts and how to help individuals make a real decision, take the theory and put it into practice. And so what you'll find is that individuals will think that a solo 401k competes with an IRA, as if they have to choose one or the other. I have plenty of clients and investors that I've worked with over the last nearly 20 years that have both a self-directed IRA and have a self-directed 401k, also known as a solo 401k for those that are solopreneurs, self-employed with no employees. Now, here's the advantage of a solo 401k for folks to take away. And of course, this is self-directed. You can self-direct an IRA like you can a solo 401k into real estate partnerships, into rental properties, private money loans, all the types of asset classes that I talked about. A solo 401k can allow you to make much higher annual contributions. For example, in 2025 here, with a solo 401k, you can contribute up to $23,000 when you're under the age of 50. When you're 50 and over, you can contribute up to $31,000. And then from there, if you're 60 to 63 under the Secure Act 2.0, there's actually a catch-up of $11,250. So it's not just $7,500, it's $11,250. Probably a little bit too much information for this podcast. We can go into those details in another one. But here's the long story short. With a solo 401k, as an employee contributing and an employer, because there's an employer side to this, you can contribute in 2025 up to $70,000. When you're 50 and over, that can be up to $77,500. And there's a way to have all that money flow into what we call a Roth bucket. So a solo 401k, similar to a Roth IRA, but separate, a solo 401k has a bucket, we call it, that allows you to make your contributions after tax, so you don't get a deduction for it right now, but all of your growth is tax-free. And when we dive into the deep review of solo 401ks, we talk about three buckets: a Roth bucket, a pre-tax bucket, and then a post-tax contribution bucket. Bucket number 3 is something that most people are not talking about, don't know about. That's what allows you as a solopreneur to keep your salary, keep your self-employed earnings low, so you keep your Medicare and Social Security tax low, but you can still get that $70,000 or $77,500 all into a Roth bucket. So you can imagine 2 years of contributions, you got $140,000 and some change in the solo 401k, and then you can use that solo 401k to invest in debt finance, real estate opportunities, real estate partnership syndications. And one of the things that I talk about with the solo 401k in conclusion here is that there's a unique advantage of a solo 401k compared to an IRA when it comes to investing in debt financed real estate directly, or if you will, indirectly through like a real estate syndication or an apartment building type partnership transaction where there's generally debt on that property. With a solo 401k, you can be exempt from a little known tax called unrelated business income tax. And in this context, oftentimes referred to as unrelated debt financed income tax. So IRAs, still very powerful to invest in real estate. Solo 401ks, depending on the individual situation, can be even more powerful.
I know Paul asked about the custodian. We're going to get into that, and we're going to briefly mention UDFI, which I think you just talked about. But it seems like if you had a choice between a self-directed IRA and a self-directed solo 401k, you'd kind of choose the 401k because it's a little bit more flexible. Is that correct? And if so, how do you get to the point where you can do the solo 401k rather than just a standard self-directed IRA?
Yeah, Jim, where I always start with this, when I'm having conversations, is if the individual is interested in investing in, let's say, a debt finance real estate syndication, which most are, right? You're going to invest in a multifamily opportunity. There's going to be debt on the property. And so you're going to have the unrelated debt financed income tax. And so in that particular case, if they want to invest in debt finance real estate transactions, then absolutely a solo 401k, providing they meet the qualifications. Because it's easier said than done. Not everyone will qualify for a solo 401k. So to answer your question, Jim, in terms of the qualifications, the first qualification is you have to have earned income. When I say earned income, I'm talking about income that you're paying, think Medicare and Social Security tax on. So if you're a sole proprietor, maybe you have an LLC, maybe you have an S corporation, and you have earned income, a salary you're paying yourself, or self-employed earnings. So if you're filing a Schedule C and a Schedule SE, you should qualify. If you're an S corporation, you're paying yourself a W-2 salary, you should qualify. So you take the earnings, and that's what applies the contribution to a solo 401k. Now, if you have someone that, let's say, has an LLC and all their income is passive income, they don't have any earned income, then the solo 401k isn't going to work. Despite what some people might say. Some people say, well, you just have to have the intent to have the earnings. Well, I would argue against that because when I go to the IRS website, it directly states that your contributions have to be recurring and substantial. And if you can't meet that test, it's a facts and circumstances matter, but if you can't meet the making a contribution in the first year, you're probably not going to meet that test. And so I think it's really important for folks to understand that. The second item in terms of qualifications is you cannot have any W-2 employees with the exception of your spouse and yourself, of course, which is nice. If you have, let's say, an S Corp, you're flipping houses, you're a general contractor, whatever the case may be, you don't have any W-2 employees, but your spouse is working in the business, great. Open up a solo 401k, and then you can do your maximum contributions, and your spouse can do their maximum contributions as well. And for someone that says, you know what, the juice just isn't worth the squeeze for me to try to figure out how to set up a business or be a sole proprietor and a consultant and have a solo 401k, if you have IRA or 401k money to roll over into a self-directed IRA to then invest in debt finance real estate transactions, you're going to find when we go through it that unrelated business income tax it's not a scary thing. It's not something someone should be afraid of. It's just a matter of something that one should understand and do the math and make sure that it makes sense for them. Or the alternative, and I've heard people bring this up on some of the podcasts that you guys have done, which is, there are opportunities out there that don't trigger unrelated business income tax. For example, most private debt funds, when you look at the K1, it's interest income. Well, interest income is not subject to UBIT in your IRA in 99% of cases. So it might be a matter of someone saying, well, I'm going to invest in these opportunities with my IRA, and then these opportunities, maybe with leverage, they use a solo 401k, or they use their non-IRA money to do so.
I imagine there's a process behind an individual investor finds a deal they want to invest in and they want to actively pursue it. They want to use their self-directed funds to do so. It can't be as simple as going onto like a Fidelity website and buying a stock or a mutual fund, right? What does the process look like for somebody step by step to actually make that investment? And how does the role of the custodian or evaluating custodians on the front end before you actually open the account play into that?
It's a 3-step process. So the first step of the process is establish and fund the self-directed IRA, or could be a solo 401k. By the way, could also be an HSA. A lot of people aren't aware that you could self-direct a health savings account, which might be a whole nother topic in of itself. But the first step is establish and fund the account. The second step would be to direct the money from the self-directed account to the investment sponsor, to the bank account that they provide through your subscription. Or if you're buying a property, sending the money to a title company. If you're making a loan, sending the money to the title company, the borrower, or an attorney's escrow account. So you direct the money from the account to the destination. And that's purely done by the individual account owner. So that's one of the things you'll learn about trust companies and custodians is they don't give tax, legal, or financial advice, just as I don't. We do provide a lot of education and information, but it is purely at the discretion of the individual investor to send the money out. So that's step 2, direct the money out. Step 3 is manage and monitor the investment. And so that's the responsibility of the self-directed investor as well. And then to go back to number 1, open and fund the account, to scratch away a little bit more at that, when you establish and fund the self-directed IRA, and as you're going through the funding process, that could be done via a rollover from a previous employer 401k, a TSP, thrift savings plan rollover, 403b rollover, 457 deferred compensation rollover. We call that a direct rollover. And when individuals open their self-directed IRA, they want to make sure that they call their plan administrator and they're very direct in that this is a direct rollover because you don't want taxes or penalties associated with that rollover of funds. And so that's how you do it. The money goes directly from financial institution A to financial institution B, and the funds are deposited into that respective account, no taxes or penalties. And then you have a transfer from an existing IRA. So if one has an existing IRA, they simply transfer the funds over. Once the funds are in the account, within just a couple business days, the funds can be directed out for a real estate transaction. And to give you a quick example there, let's say someone's investing in a real estate syndication. So they're going to provide to their custodian trust company, in this case, I'll say equity trust company, a copy of the private placement memorandum, the LLC operating agreement, and then the subscription agreement. So in most cases with real estate syndications, the investor, self-directed IRA investor, is filling out a subscription agreement. They're going to fill that out in the name of their equity trust IRA, equity trust company, custodian, FBO, their name IRA with the IRA tax ID number. They submit those documents to Equity Trust. And within just a couple business days, Equity Trust will wire transfer the funds out for the investment. The beauty of it is that there's no due diligence that we need to do on the investment, which allows us as a trust company or custodian to be able to operate with a high rate of speed, where money can flow into the account and money flows out of the account very quickly. You do have to keep in mind that when you're transferring or rolling over money from another financial institution, we as well as you are at the mercy of that financial institution. So you just want to make sure if you know you're going to invest in real estate that you start the process well in advance so that you don't create any delays.
We've mentioned this a couple of times. We never really asked it. Can you talk about the role of the custodian, the trust company, and how do you choose the right one? I know that I had a self-directed IRA, and it was just really a hassle because every time you wanted to do something, you got to send something to the trust company. They're going to charge you $200, and then they send it back, and you're asking permission to use your own money, which for me got a little bit frustrating, and I wasn't with the right company. And there's also, if you're doing real estate like we are, you probably want a different trust company than if you're doing something else. And there's also a difference between active, where you're having a bunch of transactions, or passive, where you're sending a wire now and again. So that's a long-winded way of me asking, how do you pick the right custodian?
So the role is to custody your IRA and the assets within the IRA. Now, you will learn that a solo 401k is slightly different because with a solo 401k, you don't necessarily need to have a custodian. You can have a custodian if you choose to do that. But with a solo 401k, you're the trustee, and then you can have a bank account for that solo 401k. And to your point before, Jim, in terms of speed of transactions, that can be very quick with a solo 401k. Specific to IRA, Roth IRA, traditional IRA, for some folks, it might be a SEP IRA or simple IRA. Could even be an HSA, health savings account. Again, I have a client that he invested in a commercial real estate syndication partnership with his health savings account, and that grows tax-free and it will be taken out tax-free for medical. And so the role of the custodian is to custody the IRA, HSA, let's just say IRA or HSA. Again, 401k is a little different. To custody that account and the assets within that account. And their role is to ask for the documentation associated with the investment. And then the role is to take the request from the individual investor and send the money out. That, at the end of the day, is the role of the custodian. The custodian or trust company is not performing due diligence on the investment. They're not asking for audited financials. And the truth of the matter is an individual doesn't want that. in most cases. The individual wants their trust company or custodian to say, here are the documents, everything is checked off the list. Please send my money out as quickly as possible. That allows us, for example, and I can put on my trust company and custody hat for a moment here and say that what that allows us to do as a firm is it allows us to keep fees low, and it allows us to operate at a high rate of speed for the client. Whereas if we were doing all of that type of work, if we were functioning as a fiduciary, and we don't function as a fiduciary, we're what's called a non-fiduciary trustee custodian. So we're much, much different than other financial institutions that might require more of that broader overview of work done. So we can allow that client to move very, very quickly. Many trust companies and custodians have online technology portals. I don't want to speak for other firms. Our firm in particular, we have an online portal that allows individuals to upload their subdocs, their operating agreement, their private placement memorandums, and then we can wire transfer the money out within just a couple business days. And there are some instances where folks need to move funds very quickly, and we have the ability to be able to operate under those time constraints. And then, of course, to go to your question, Jim, in terms of evaluating custodians and trust companies, one of the first things I encourage folks to do, and let me be transparent, I do represent Equity Trust. So I know some people might say, well, there can be some biased opinions here. I've been in the industry for close to 20 years. Let me try to make this as unbiased as possible. The first thing is number of years in the business and size. I know for some people, they say, well, that doesn't necessarily always matter. I would argue against that. And I'll argue against that because I'll tell you in the trust company custodial industry, in the last year, I've seen some acquisitions that have occurred. Some companies that are a little bit smaller, some companies that haven't been around as long. And I'll tell you, those individuals have gone through some challenges. I've seen some of those individuals go through some challenges. You want to be working with a trust company or custodian that you feel confident is in it for the long haul, and they're not going to sell to a larger firm, maybe a little bit down the road. Number of employees, I think, is a major one. So you can go on, the trust company or custodian's website and find out, how many employees do they have, and then also the service model that they provide. So some firms are much more technology focused and less on the customer service side, and then other firms are the opposite. They have very little technology, but they're really, really good with their people and their customer service. And so trying to find a firm that has a good balance of both. I will tell you, it's hard to find one that is up here with technology and up here with service. Usually it's one or the other. And it's just because of the economics of the industry. So find someone that's kind of in the middle of the road there. The model that I've built here is a single point of contact for every new customer onboarding model, where each individual customer works with a single point of contact onboarding specialist and kind of helps them through, especially their first 60 days, rolling over funds, transferring funds, and then executing on their investments. I'm sure there's a lot more we could talk about there, but hopefully that answered the question, Jim.
Yeah, definitely.
John, I want to touch on a point that you made earlier in the conversation regarding unrelated business income tax and unrelated debt financed income as it relates to using leverage on investments inside a self-directed retirement account. I think from my experience in talking with investors, there's some hesitation in getting involved at all. They're worried about what UBIT triggers and how much tax liability there could be and how much of a headache is involved in actually having to deal with those taxes come tax time. Can you kind of dispel the myth that UBIT is evil, and what exactly are people worried about? Is it as big a deal as it made out to be?
You're absolutely right, Paul. There's a lot of people that, there's sort of a lot of fear mongering, if you will, with respect to unrelated business income tax. And the way I always like to start off is no profit, no UBIT. If you have UBIT, that should be looked at as a good thing because that means you have profit. And then you start to dissect, okay, how much of my profit is being subject to taxes? So for those of you that are wondering what in the world is UBIT, unrelated business income tax, or unrelated debt finance income tax? Well, UBIT is a special tax on IRAs and other tax-exempt entities, could be 401ks as well. And it's a much broader conversation, but let me speak in the context of debt financed real estate. And the best way to understand this is to do a quick example. Let's say I buy a property for $100,000 with my IRA, and I borrow $50,000. So I'm 50% leveraged. I will pay UBIT tax, also known as unrelated debt financed income tax, on 50% of the net profit. As I pay down that mortgage, less and less is going to be subject to taxes. So when I compare this to investing outside of an IRA, although there are things like 1031 exchanges and other tax strategies, the reality is you have to pay taxes on what? 100% of your profits. In this case, you're only paying taxes on a percentage of the profits. And that percentage is dictated by the percentage of the property that's leveraged. Now, you can take that same example and put it in an LLC partnership. So if your IRA is a 10% partner in a partnership, well, then you take that allocation and that just flows through the limited partnership or the LLC to your IRA. Now, I did say net profit. You have to keep in mind that we have some deductions. So you have all your operating expenses and you have depreciation. It's the one instance where you can use depreciation because you have this unrelated business taxable income, or UBIT, also referred to as unrelated debt financed income tax. So don't think of it as something that you shouldn't do. Just understand what it is. You file what's called a 990T tax return. Good news is we know people that do that in the industry, and we can help individuals when necessary. The last thing that I'll mention to conclude on all this, because we talked about solo 401ks earlier. One of the advantages of a solo 401k is under Section 514C9A of the tax code. There's actually an exemption with respect to unrelated debt financed income tax. Now, there's some criteria that have to be met. And this podcast would be 4 hours long if I went through all that criteria. Here's what I'll tell you. In 98% of cases with debt finance real estate or real estate partnership type syndications, a solo 401k is going to meet that exemption. Give you a quick example. I have a client that invested $100,000 in a multifamily apartment building project. And she just got her first distribution check last week. And what she did is she rolled over a traditional IRA into the solo 401k, then converted that to the Roth side. She is a sole proprietor. She doesn't have a lot of income, but she has some income in order to qualify for the solo 401k. That way, all of her profits are going to go into the Roth side of the solo 401k. They're going to continue to grow tax-free. She'll never pay unrelated business income tax. And when the property sells in 3 to 5 years from now, no capital gains. Now, a couple last items to mention here on UBIT. When you look at the UBIT tax rates, you'll see the estate and trust tax schedule, and it gets to the highest rate of 37% really fast. It's almost $16,000, and it gets to 37%. A lot of people look at that and go, oh my gosh, 37% on all my gains when the property sells? No. Long-term capital gains tax rate, UBIT, you can go directly to the IRS website and find this, is only 20%. So to give you a quick real case study that I just pulled a K1 and a 990T that we processed here at Equity Trust, a client invested $100,000 in 2021. The property sold in 2023. They had $164,000 capital gain. And when we adjust for the basis, they had 70% of the profit subject to UBIT, not 100%, but only 70%. When it was all said and done, they paid $23,000 in taxes, but they made $140,000 tax-free in their Roth account. That's a 47% annualized return on investment. So what you want to look at is, yes, you might pay taxes longer term, net your profit out, factoring in the taxes, what's your return on investment? And if that's better than what you can make in the traditional financial markets, you probably have the answer to your question there.
That's excellent. And I think what we're going to have to do is have you on again in a few months and really dive deep into some of these subjects. But that was a great overview. And again, we'll dive deeper. So the final question, I think, is, we've talked about self-directed IRAs and solo 401ks. And at Passive Pockets, we're all about investing in real estate syndications, right? That's the focus. If you're going to invest through these vehicles, what should people be looking for as syndication investors? Are there some tips? Is it the same as if I'm investing in my other account, my taxable account, I guess? You mentioned debt is a good thing because those are taxed differently. Can you kind of just summarize what we should be looking at as far as syndication investors when we're investing through these vehicles?
I'll start with mentioning that we don't give advice or recommendations, and I certainly don't. But from an educational perspective, the first step of the process is I always look at every investment. I use this framework. I think you guys like to use frameworks as well as investors. I do. Here's the framework. Number one, does it make business sense? So look at a real estate syndication, private debt fund, whatever type of investment you're looking into, and say, does it make sense from a business perspective? Number two of the framework is how do I do it most tax efficiently? I look at it as an investor myself, I have my quiver of arrows in my back, right? And I have taxable money and I have tax advantage money. I have my 401k Roth, my 401k traditional, I have my Roth IRA, and I have my HSA. And when I look at opportunities, I say, how do I do this most tax efficiently? So for some folks, they might look at a real estate syndication with debt and say, well, I can't do a solo 401k. If I use an IRA, I'm going to have to pay UBIT tax and file a 990T. So why don't I do this investment with my non-IRA? And then over here, I'll use my IRAs for transactions that don't trigger unrelated business income tax. For example, investing in a private debt fund, or maybe making a private money loan where they have interest income, or maybe just buying a rental property free and clear without debt. And then there, of course, could be someone in that particular instance that says, hey, I understand the economics of UBIT here. This opportunity is good enough where I can argue paying the UBIT tax, and I'm just going to pull the trigger on using my IRA account. And we've had hundreds of thousands of people that have done that over the years. And then the third piece of the framework, and I leave this last because if I put it first, people think it's a little bit odd, is lifestyle. And it's something we don't talk about a lot. I don't talk about it a lot, mainly because you've heard me on this podcast. I spent a lot of my time in the tax code and really understanding the economics and the strategy here. But lifestyle is important, and it's something we probably don't talk about enough. And that is, does the investment meet your lifestyle? So if you're going to buy a rental property, a single family rental property, okay, are you willing to take on another rental property? Are you willing to put in the work to do that with your IRA, your 401k, or HSA? Or are you better off investing in something that's a little bit more passive? So that's the framework in conclusion. Does it make business sense? How do you do it most tax efficiently? Which accounts do you bring in? And then third is the lifestyle. And do keep in mind as well, for folks that have multiple IRAs, like a Roth and a traditional and HSA, there are ways to partner those accounts together. We talk about that in some of more of the advanced podcasts and education that we do around partnering multiple accounts. You have to follow very specific rules so you don't violate the Internal Revenue Code. But there are ways to, again, raise capital across multiple different money sources that you have in order to fund a, let's say, single family rental property or a private money loan, or possibly invest in a real estate syndication.
Well, John, this has been great. Really enjoyed the conversation. Very insightful. And I know that I myself have learned quite a bit and have some work to do on my tax strategy and my approach moving forward. So just want to thank you for coming on. We need to have you back on again so we can dive into more of these details.
I appreciate it, Paul. You know, I'll leave you with, and I'm glad you said that about tax strategy, because there's a lot of content here. Here's what I've always found in my experience in doing this nearly 20 years, is the tax code, tax strategy can get incredibly complex. 990Ts and UBIT and UDFI. And what I found is that the opportunity, it thrives in the complex areas. It's the simple areas of the tax law where sometimes opportunity just doesn't exist. It's the complexity is where the opportunity just lives and breathes and continues. So I encourage folks, when they hear UBIT and they hear complex tax strategies, to actually run towards it. Don't make bad decisions, but run towards it instead of away from it.
That's great advice, John. And just a final close, if people want to hear or learn more about Equity Trust or connect with you directly, what's the best way to do that?
Best way to find us, our website is trustetc.com. You'll also find our YouTube page. We have a ton of educational content. So that's just Equity Trust Company on YouTube. And lastly, I understand within the Passive Pockets website, there's all sorts of material that Equity Trust has to help educate and provide additional information. So feel free to tap in there as well.
Excellent. Thank you very much.
Thanks, John.
Thank you.
That's it for this episode of Passive Pockets, brought to you by Equity Trust. A huge thanks to John Bowens for breaking down how self-directed IRAs and solo 401ks can be powerful tools for passive real estate investors. If you enjoyed this episode, don't forget to like, subscribe, and share your thoughts or questions in the comments. For more resources on passive investing, visit our website, passivepockets.com, and join our community with a 7-day free trial. Thanks for tuning in, and as always, happy investing.